This is the end.
Welcome to another Dow Jones update. Sorry, I was just listening to some music there. Now, basically, this is the AriasWave view of the long-term pattern of the Dow Jones. Now, I'm going to explain to you this view in case you haven't seen it before, especially the new followers. Basically, how I am seeing this market in its entirety since the Great Depression. Now, I'm going to go to the longer term chart shortly, but first, I just want to explain this pattern to you so you understand why I believe we're in the final move now. Okay, so since the GFC low, which was a wave E, end of wave B in brackets, this whole move up since the Great Depression is an expanded type 2 zigzag. So we're in C wave, the last move since 2009, and this is a wave 1 right here, right? We had a very small wave 2. Yes, it was tiny. Imagine buying that little dip. Beautiful. And then we had wave 3, right? So zigzag 1, 2, zigzag 3, 4. Now 4 was sideways, long in duration, and deep, which is alternation because of the little wave 2, right? That's alternation in play. Now, since then, you obviously you know what's going on with wave V. I put updates on that all the time. I post repeatedly, trying to understand where this thing will end. So if you haven't seen that idea, I'll post it below, mapping out the last waves. Okay, now that will complete the C wave in brackets of wave B. Okay, so let's move on to the DJI chart and we'll go to the monthly. Okay, so this is the B wave since the Great Depression. Okay, now I'm just going to clear some of these markings off so you can see what's going on here. Great, no worries. So the Great Depression was a wave A. It was a zigzag. It's a type 2 expanded zigzag, basically stretched out zigzag. Now, if you look closely, I'll just quickly zoom into this so you can see what I'm talking about. Right now, wave 3s don't look like that. Just so you know, wave 3s are not choppy in the middle. Okay, wave 3s are the sharpest in the middle. So if this was a 5-wave move, this middle part here would be sharp. Except this was the sharpest parts were the A and the C. Can you see it? So that's if you look at the subdivisions there on this one, right? You'll see 3, 3, 5, 3, 5 in there. Okay, you need to spend some time looking at that properly, make your own conclusions, right? This is AriasWave we're talking about here. We're not talking about AriasWave or any other theory, right? There's no way any other theory would even come close to the level of detail that AriasWave goes into in determining these moves. Okay, so the B wave was expanded within the B wave, right? Now you've seen that before. Check out my Nasdaq video. I will post that below as well. Same thing, mapping out the last waves, where you see quite clearly how B waves within type 2 zigzags can be expanded, right? And this is no different. Okay, now even the B wave within the B wave within the B wave was also expanded, right? That sharp move that happened here in the 60s, that was actually also stretched out type 2, expanded type 2 zigzag, right? So the B wave portion in the middle here, you can see it lasted from 62 to 87, right? But it was all stretched out to the upside. That's the whole reason why this whole move is expanded, right? And then we get to the top here, we have C, a weak C wave, and a D and an E. Now, just so you know, the 87 crash was also an E wave, right? It was the E wave of the B wave in brackets for the B wave. Okay. So this channel is actually drawn by basically from the start of the move up and then the E wave, which is the GFC low. And using this type of channeling, you can get basically to the end point of the zigzag. Now, we're only using the channel as a guide. Obviously, the waves are the most important thing. Now, you'll notice how waves do react to certain levels and channels depending where you put them. For a normal zigzag, you can actually do the same thing, and it's a lot more accurate. Not these type of expanded type moves. All right. So these are a little bit more complex. Now, the C wave that's coming will probably end up going down to retest the 87 lows, right? It will break through the GFC lows. It will retest the 87 lows. That's what I think. So far, this is all forecasting and prediction, right? And then we're going to see a D wave bounce to retest the break of the GFC lows in the E wave. So E waves are very important in markets. They form support for moves, right? So they're the most important waves in all markets, in my opinion. Using AriasWave, I've determined this because they basically form support, right? You can't have a new trend without a wave E happening first, right? So these areas will be tested, and then most likely we will get another move down that will come back to the area where the impulsive wave actually ended, right? And now this is an expanded correction, right? Now I'm not saying it's going to go straight down like this, but I'm just giving you an illustration for illustration purposes, right? Now there is another view on this, but I don't think it's going to happen, right? Now if you look at the B wave CDE here, see how it created its support up above. Now I don't believe this is going to happen because of rates, right? Interest rates. Now I'll link that idea below also, so you understand the severity of what's coming in interest rates. In fact, you can't see the detail. Like I do have it on my course. The B wave down in interest rates, we're only like basically seeing the C wave down since 81. But the whole pattern actually started in 1440. Okay, so 1440 interest rates, the A wave went down to 1570, which was quite a big move to the downside, and it happened fairly quickly. And then we had a correction all the way until around the Great Depression, and then we have the wave up in E all the way up to 81. And that's when rates topped in 81. So because of the move that's actually coming in interest rates to the upside, a C wave will definitely cause this kind of thing to happen, right? So it's called a deleveraging. I'm not too sure if you're familiar with Ray Dalio. He talks about deleveraging and that type of thing. And basically, we're in the same position that we were back in 1929 right now. So it's the same sort of scenario, except this time it's going to be much worse because this particular move is an expanded correction, right? In 1929 was the end of, right here you can see, was the end of a larger impulsive move that started hundreds of years ago before that, okay? But this particular move here is an expanded B wave, so it's a completely different ball game, which makes me believe that we're going to see a double depression, right? Now, if we don't see a double depression, it'll basically just bounce higher in D wave and then come back down again. But I don't believe that's going to happen because of symmetry. Not only just symmetry in the pattern, but also because this is already an expanded correction. Typically, when the correction ends, it tends to end back, like I said before, at the top of the initial impulsive move, which is a long-term move. Now, when you think about it this way, right? We broke, and now if you have a look at this trend line here, this faint little trend line that's going across the page here, this is actually drawn from a long-term chart of stocks going back hundreds of years, right? So I've just basically managed to find the way using that chart to create this line here. And the way that it was created was by using the top of the Great Depression high and also this point right here, which basically is a retest. And that's on the longer term chart. And I just superimposed it onto here. Now, whether or not this plays a role in where these markets fall down towards, nobody knows, right? At this point in time, I'm only using the information that I have according to AriasWave, where corrective patterns expanded tend to come back to where the breakout happened, right? And that's reverting to the mean, all that type of thing, right? Now, obviously, you need to create support before you can continue to grow and to progress in the pattern, right? Now, as I said to you before, E waves are important, right? They create support, and you'll notice that the price fell out of this channel in the 80s, in the 70s and 80s, and it came back into the channel and retested that channel, and that was the 87 crash, right? So that's an important level, and you'll notice it's in that channel, and then that E wave is also where I drew the line. It's all connected, right? So it's very interesting because it sort of created a channel that was used in the future. Markets, they know ahead of time what's going to happen. It's just about trying to figure out what is happening, right? Now, using AriasWave, I believe, is the best method possible to do that. So when we create this E wave in the future, that will mark a very important support level for future progress of the Dow Jones, right? So the most critical thing you have to understand right here is that this is an A, B, C, D, E scenario. It is an AriasWave scenario, and that's why this is going to happen most likely, right? So using the very best and latest AriasWave techniques, this is the kind of thing that I'm seeing. Now, you may think, oh, this is devastating. This is terrible. It's regardless of that. They're just numbers on a chart. Obviously, it's not a good thing, but this is not about that. This is not about that at all. Okay, this is about the waves, the patterns, AriasWave, right? Now, you have to understand that if you look in long term, and this is what AriasWave is all about, long term patterns are the key to understanding price movements. That's why I have the programs, because if you understand the longer term pattern, you will then be able to understand the shorter term patterns and then how to trade them, because like I said, they're all fractal patterns, and it's just a matter of knowing where they're going, basically. So that's basically it. Okay. Now, at this point in time, obviously, this is, my view. I'm not saying it's going to happen 100%. Nobody can know the future, obviously, but chances are, given what we're looking at across all the markets, this is the likely thing to happen. Okay, so obviously we're going to find out, and I'm in for the long haul. I'm ready to test and to find out what's going to happen. So hopefully you found this video interesting and enjoyable. Thank you for watching.